Good morning, everyone. Today is Wednesday, July 22nd, and thank you for joining us for another edition of the Market Commentators. My name is Andy Wilms, President and CEO of the Milwaukee Company, and joining me this morning is Mike Wilms, who is the Milwaukee Company's Chief Operating and Compliance Officer. Quick reminder that nothing in this podcast should be construed as investment advice, and the views expressed represent Mike and my personal views and not necessarily those of the Milwaukee Company. And with that all said, good morning, Mike.
Good morning, Andy, and welcome to the call, everyone.
Thank you for joining us. Mike, I think let's start with a quick recap of the market action last week and so far this week. Last week, market participants seemed to take notice of the incredibly high valuations of some of the mega tech stock companies and other high growth companies that have led the stock market rally since March. Consequently, for the first time in quite a while, the Dow outperformed the tech-heavy NASDAQ as investors seem to kind of roll out of the inflated tech stocks into the more lagging value stocks that are represented in the Dow. This week, the NASDAQ regained its mojo on Monday, jumping by more than 2%. And the S&P turned positive for 2020 with closing with a 60 basis point gain. Yesterday, the Dow Jones Industrial Average and the S&P both posted modest gains, while the NASDAQ fell under just 1% in very volatile trading, by the way, for the NASDAQ, as investors pulled back a bit on technology names that have been soaring. Another major development, of course, this week is earnings week, and it's earnings week, and a lot of companies are reporting their earnings for the second quarter. And Mike, maybe you can bring us up to date on that.
Well, and today will be a big day for earnings with some of the tech leaders reporting and some of the market darlings, Microsoft, Intel, Tesla, American Express, Twitter. And to this point, there's been a fairly good earnings result with some of the larger names that are very familiar to investors: IBM, Texas Instruments, Dover Corp, the banks, all having reported better than expected earnings. And to your point about the NASDAQ and its mojo, NASDAQ reported as a company reported their earnings this morning, and the president and CEO was on CNBC, kind of explaining why the NASDAQ has been doing as well with the elevated level of trading and the focus on technology, which has obviously been the NASDAQ's focus for the last 20 or 30 years.
Right.
So, earnings to this point, the market expectations were for the second quarter earnings in total to drop by between 40 and 45%. But to this point, there's been more earnings beats than misses, and hopefully that number will not be as bleak as originally forecast.
Well, that would be great, obviously. You mentioned the increased interest in tech stocks in general, and I suppose that might be driven in part by the fact that we have so many more younger investors getting involved in the stock market, and that in part is due, I think, to the drop of the barriers to get involved. I mean, in the past, when we were young, it was quite difficult to participate in the market. You had to have a stockbroker who was willing to work with you, and if you didn't have a lot of money, that was difficult. Trading was much more expensive. You didn't have anything like Robinhood, where you can go on the internet and trade for very inexpensively or virtually nothing. And now it's gotten to the point where you can buy fractional shares, so you don't need a whole lot of money to participate in the stock market or to be actively trading in the stock market.
And that was while I was watching CNBC this morning, both Fidelity and Schwab were advertising their fractional share programs. So investors are in a position to buy a slice of an individual share at $5 a slice. So, I mean, when you think about Amazon at 3,000 and change. Think about how many slices at $5 you need just to absorb one share. But by the same token, one of the big market bounces for individual names in the past had been when the publicly traded companies would split their stocks and try and control the actual dollar price where it was more affordable so that individual investors could participate.
Right. That certainly won't be as necessary now that you can actually buy fractional shares. Anyway, for the most part, I think it's a very good thing that we're getting people involved in stocks at an earlier age, because stocks offer the best long-term return potential. I just worry about the timing of it, because, I think if young investors aren't particularly careful, they could end up getting burned in here, and might end up being kind of a life-altering event. If they get burned too hard, they may turn away from the market, on an extended basis.
Absolutely.
All that being said, which we would hate to see happen. All that being said, let's talk a little bit about the situation in COVID-19. It's been a very active period of time the last few days. So I thought we'd take a little bit more time maybe than normal to talk a little bit about what's going on, because clearly not only is that affecting all of our day-to-day lives, but it's going to have a tremendous impact on what happens with the stock market and the economy as in general from here. On last Thursday, the U.S. shattered the record for new cases for the 11th time in a month, reaching more than 75,600 new cases. Although that number is probably greatly underreported. There's been the CDC issued a report yesterday saying that the number of cases being reported is dramatically under what's actually occurring, because there's so many asymptomatic people out there that aren't getting tested. Since last Thursday, the number of reported cases had been falling off a bit, which kind of offers maybe a slim ray of hope that the recent surge in cases and the modest upturn in deaths could be fading, but it's obviously too soon to know that for sure. As these cases are soaring, we're seeing, its impact on the economy, with more than half of the country now having some sort of face mask requirement in place. Alabama, Arkansas, and I think Texas and Colorado all issued statewide mask mandates in the last few days. But this is being met by a staunch resistance from those who see masks as an attack on their personal liberty. And most recently, Chicago now has reported it's going to roll back its reopening, with bars and that won't be able to serve alcohol indoors, and people who remove masks will have to be banned, and indoor fitness classes are going to be limited to 10 people, so on and so forth. So, and I heard this morning now that Illinois is on the verge of listing Wisconsin as one of the states that, if you go to Wisconsin from Illinois, you're going to be going to be directed to have personal quarantine, because Wisconsin's cases yesterday actually were higher than that of Illinois. So all of this would be kind of gloomy, but fortunately the news isn't all bad. There's been a great deal of progress on the treatment and vaccine front, and I don't know if you'd like to bring us up to date on that a bit, Mike.
Well, I think everybody's aware of the tremendous amount of resources that have been allocated to try and develop an effective vaccine and treatment. There are 150 vaccine candidates currently in the pipeline. 3 or 4 are showing the most promise, with the Oxford University vaccine potentially in a position to receive approval as early as September. They've signed a licensing agreement with AstraZeneca to produce the vaccine. It's in a late phase 3 clinical trial in human patients, and it's a very hopeful progress as that's moving through the phase 3 trial. There are several other vaccine candidates that are percolating. The BioNTech slash Pfizer candidate. There was a news story this morning that the U.S. government has signed an agreement to purchase almost $2 billion worth of the vaccine as it can be produced. The Moderna vaccine is progressing. They expect to be in a position to apply for approval by the end of 2020. So the amount of resources that have been allocated to develop a vaccine and treatment are pretty incredible. And as you and I had talked about, the remdesivir data is continuing to be collected as the drug is used as a treatment. It was last week that they released additional data indicating that if a severely ill patient was given the remdesivir, that patient's likelihood of dying went down by 62%. And that's a substantial improvement. It's a doubling, essentially, of the initial trial response on remdesivir, where the trial population was just a small 45 patients. So, everyone is working as hard and as diligently as possible to find a solution.
I think that's exactly right. Unfortunately, not to throw a damper on all that good news, and it is in fact good news. Questions still remain that even if we do identify a vaccine, how long that vaccine will provide immunity. There was this study by, I'm sure you've heard of it, by this King's College in London that raises serious questions in that regard. In that study, they found that the number of active antibodies, called neutralizing antibodies, declined significantly after just a short period of time. So, it's one thing to have a vaccine. It's a second one for it to last lifetime or several years of immunity. I think a lot of the tests of these vaccines being developed have found that you do almost need to get a booster shot. So it's going to be a little more complicated to administer. And so my point is not that we should be discouraged. I think we should be very encouraged about the vaccine, but the market might be putting a little too much faith in the development of the vaccine and not putting enough emphasis on the risk that the vaccine may have a very short effective period.
There's no question, and I think some of that's tied to the type of vaccine, where it's an RNA genetic-based vaccine, and the period of effectiveness for preventing the disease might be as short as just 2 months. As you know, and everybody is familiar, most flu vaccines are for the season. So you need to get a vaccine every 12 months.
Right.
So, as we go through the process, the science will need to be developed, and hopefully we do come up with a workable, safe alternative.
Right. We all are hopeful, sharing that, you share your optimism or desire to see that happen, I guess I should say. So now let's move into some of our roundtable part of this of our podcast this morning, and I'd like to lead off with what we've already talked a little bit about, which is the NASDAQ. And the fact that its outperformance came to an abrupt end last week, but it's resumed its upward tear this week. Kind of riding this wave of enthusiasm for the so-called FANG stocks. Facebook, Amazon, Apple, Microsoft, Google, or now its parent is Alphabet, which now represent, I think, 25% of the NASDAQ index. And without those stocks, you'd see much different results for both the NASDAQ and the S&P 500. I think if you take out the FANG stocks, the S&P is actually down considerably for the year, would be down considerably for the year. So it leads me to this question. Do you think we're experiencing a tech bubble at this time?
Well, I did take a look at the price earnings ratio for the triple Qs that track the NASDAQ 100, and at 47 times earnings. I mean, you know, that obviously is a lofty level. But the NASDAQ CEO on the business program this morning was talking about the market's expectation for those companies to continue to benefit from a migration in technology to deal with remote officing and cloud computing and where some of the economic trends are migrating. So, you know, it's all beauty in the eye of the beholder kind of thing. I mean, I'm more of a value guy versus a growth. I sometimes it gets really hard to understand earnings and other investors' expectations.
Well, you know, I know there's always a story that supports or provides a rationale for why, you know, bubbles are occurring before they pop, right? I mean, if you didn't have that story, then you'd never have the bubble in the first instance. But, you know, I think the combination of the public participation we talked about a moment ago, and just these incredible valuations make the tech sector very, very vulnerable. And the fact that it's all concentrated in these handful of names. I mean, if you look at Facebook, Amazon, Netflix, Microsoft, Apple, and Google, they've gained 32% in 2020. Whereas the other remaining 494 names that make up the S&P 500 were down 6.6%. This is as of Monday. I haven't updated it till today, but you know, it's just, you know, there's this law of diminishing returns, right? That suggests that as a company gets larger, it's harder and harder to keep compounding high growth rates to justify these valuations, right? The bigger you are, the harder it is to. So I think you got to be really careful here. There's a potential for volatility, you know, considerable potential for volatility, which could be to the upside as well as the downside. But I think caution is warranted. And for those investors who are maybe share my concerns, if they're invested in like, for example, a market weighted S&P 500 fund, one thing they may want to consider is going to an equal weighted version of the S&P 500 fund for at least part of that allocation. And of course, as you know, whereas the market weighted ones would put a huge percentage, I think it's like over 30% now, isn't it? Or 25% now in those select names. The market equal weight would put equal amount in each of the S&P 500 companies. So you're not getting such great emphasis on just a handful of companies.
Exactly.
So that's something you may want to, our listeners may want to at least look into. Okay, on that, let's talk about how strong or vulnerable you think the economy is at the present time. You know, I mean, we were on kind of a roll here for a while with the reopening of all the economies, and that's being reflected somewhat in what we're seeing in the very current economic data. But the you know, now that we've had this upsurge, we've seen the reopening of the economy slow, and some of this numbers, some of the economic indicators that were positive for a while have started to fade, especially those related to like unemployment, restaurant bookings, and mobility. Those things are all kind of flattening out. And you know, senior Fed officials have been warning that you know, that from the beginning that the economy would face a long and difficult road, have been watching these real-time data type and have expressed considerable concern about what lies ahead. So do you have any thoughts about whether we need to be concerned, or do you think the economy continues to be on the right track?
You know, I would lean to the conservative view. There are indications that the economic indicators that have been showing a sharp rebound have plateaued and starting to flatten. need to be watchful of the newest developments. If there is a possibility for controlling the number of cases through mandating masks and social distancing and going back to some of the CDC recommended personal behaviors. It's a time to be thoughtful versus throwing caution to the wind.
I tend to agree, and I think there's a lot of possible long-term ramifications on this for our economy. Some good, some bad, right? I mean, companies have learned to be more efficient, which I think a lot of that will carry forward after the virus has been controlled. Spending has dropped across the board in all different age groups, and especially, I guess, amongst, according to what I saw on CNBC's, has really been diminished amongst the baby boomers are spending, I think they said, up to $500 a month less than they had been before the virus. I mean, that's a potential problem. And the strength of the rebound is really debatable. It depends on which economic indicator you look at. Some, like the Philadelphia Fed Index, is suggesting the economy is doing really well. Others, like the New York Fed's weekly economic index and the Chicago Fed National Activity Index, suggest caution should really be exhibited. So I agree with you. I'm hopeful, but I believe, until there's a more effective treatment or a vaccine that's, proven to be effective, work and life are not going to go back to normal, and we have to be cautious.
I agree 100%.
Great. Well, it's always good when we agree, although it's a little more fun when we disagree. Let's see if we can find something we can disagree on. But I don't know that there'll be much. Okay. Well, I guess the last thing I'll just ask you real quickly is, do you think that the economic recovery will take longer than the market is assuming? We both feel that there's reason to be cautious. If you look at just the market's performance, you would think there's, you have reason to believe things are going to be positive, although, again, the gains are very concentrated, so that's a little misleading too. But how long do you think this recovery is going to take?
Well, I mean, in that, once again, it depends on which prognosticator you're listening to. After the June Fed meeting, the consensus with the Federal Reserve is that it's going to take until 2022 to return to the same level of economic activity that we experienced in 2019. And that really goes back to your question about earnings and the current valuations of the market. We're essentially, and especially with the NASDAQ, if the NASDAQ is up 20% in 2020 with a substantially reduced earnings picture, you got to start scratching your head a little bit. But some of the Wall Street firms are looking for a return to the same level of economic activity as demonstrated in 2019 by as early as the latter part of 2021. So, I mean, it's a moving target, and it all is going to be tied to the controlling of the number of new cases and how the virus continues to affect the economy.
Well, what do you think then about this whole new stimulus program? If we feel like the economy can be back to, could be in a position to recover on its own, do you think the stimulus program that Congress seems to be on the verge of enacting, this next round of major stimulus, is warranted? And how do you think they should go about it?
Well, that's a fabulous question, because there's so many topics that are being discussed and debated. The fear is that with the additional $600 a week of federal unemployment expiring here on July 31st, at this point, it seems like everyone in Washington is adopting a position that there won't be additional stimulus passed until sometime in August. And there's a question about whether the $600 would be reinstated for weekly unemployment as a federal benefit. There's a question about whether there'd be another $1,200 direct payment. There's a debate around providing additional stimulus and support to businesses that are struggling prior to the virus and are quote unquote becoming zombie companies where the federal government is prolonging the inevitable. So I just don't have a crystal ball to predict what this is going to look like by the time they finally get to the point of debating the final specifics in August.
Well, I agree. And, I call me old fashioned or old school, but I still worry about the deficit, right? I haven't bought into this modern monetary theory rationale where deficits don't matter. I think they do still matter for the long-term health of the country. So I would like to see us be as conservative as we can while still protecting the economy today. And I think one of the things we got to be really careful about is these direct payments. There were a lot of people who received payments, households that received direct payments where nobody lost a job. And in some cases, they were making more money than they were before the virus hit. I think we have to be really careful about direct payments. I think we have to be really careful. I think the Payroll Protection Act has proven to be quite effective. You've seen that. It's very unusual, but small businesses have actually increased hiring more than large companies have, which is a first in this kind of a recession recovery type of thing. But again, you got to be really careful who you pay these loans out to, because there's a lot of fraud. Make these loans to, because there's a lot of frauds and a lot of companies that simply don't need a second round. I understand what happened the first time around, but we have to be a lot more careful, I think, this time around. So
I would agree, and to your point about the $600. There's a debate about whether it should be an extension of the unemployment benefits, given the fact that there was over 40% of the people receiving that $600 a month in conjunction with their state benefits were receiving more than what they were paid prior to being laid off.
Right.
And so should it be a extension of an unemployment benefit, or should it be a payment to incentivize the worker to go back to work?
Yep. I understand that debate, and I kind of personally would favor the latter, but we'll have to wait and see, as you said.
Exactly.
So I guess that brings us to the end of the podcast, Mike. There's so many other things I'd love to talk to you about with our viewers, but unfortunately we're out of time. So I will thank you all for joining, and keep in mind, please, that as you consider what we've talked about here today, that you shouldn't use anything that we've talked about before discussing it with a qualified financial professional who is familiar with your personal situation and your investment objectives. And with that said, I'll say thanks much for viewing, and have a great day. Bye.
This
Bye, Mike.
podcast is for
See you
general
later, Andy.
informational
Bye-bye.
purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.